Okay, let's dive right in. What is double taxation and how does this happen?
So double taxation typically occurs when you can't take some type of credit on the opposite side of the border. So for example, if you buy a property in the United States through a corporation, you're paying corporate tax. When you take the money out as a Canadian, you pay tax individually as well. So you're paying tax twice on that same income, right? So there are certain vehicles where we can structure you to kind of avoid that double taxation situation. Typically I guess we'll dive into the details on the various structures, but typically, when you're not getting some type of credit in Canada, that's typically where double taxation arises. So.
Got it. And this is a corporation. So if a property is purchased in a corporation, then Revenue Canada doesn't see that any profits you've made, you pay your taxes on the corporate level in the US, but when those funds are repatriated, Canada doesn't account for that taxes you've paid on those capital gains to the US, and then taxes you on the total sum again, the original sum, or the only sum that you brought over?
It's the after amount. So say, for example, you make $100 to a US corporation. In the United States, you're going to pay 21% federal tax. There might be some state tax depending on where the project or the property is located, but you'll pay 21% tax. Since you're a Canadian that owns that US corporation, there's as long as a 5% withholding done on that dividend essentially to you. So that's 5% you won't get back because it's not subject to a foreign tax credit here in Canada. And essentially on that $100, you're already down $26 on that profit. So then you pay additional tax on that $74 remaining in Canada, based on your marginal tax rate in Canada. So if you make over $200,000, you're in a 50% tax bracket already in Canada. So you're going to pay about $35 on that $74 remaining, essentially. So your after-tax amount is what, 35, maybe $40 at most on $100 of earnings, essentially. So you're paying about 60% in tax on that income, which is certainly not a tax efficient way of doing business.
Yes, and most, not most, all of our investors are accredited. So in most cases, they're making more than that 200K amount a year, and they've made it in the last few years. And so if they go the route of investing through a corporation in the US or into it, does it make a difference if it's a corporation or if it's an LLC?
So good question. So LLCs are taxed differently on the US side as opposed to here in Canada. So LLCs, typically for most US investors and US individuals living in the United States, they're considered what's known as a flow-through entity. So all the income flows up directly to their 1040, their individual return, and they pay tax based on their individual rates. In Canada, if a Canadian owned an LLC, CRA taxes them as a corporation, essentially, right? So because it's not actually owning the property directly in your personal name, there's no kind of partnership type structure with an LLC. CRA deems that LLC to be a foreign corporation, which is subject to that double taxation that we just spoke of. Yeah.
Great.
All right.